Over the past quarter, markets have behaved in a relatively calm way, particularly when we consider how 2020 has played out. When we look across markets, Australian equities, really didn't do much. They sort of treaded water for the quarter. By the end of the 3 months, we actually saw them draw down by 0.1%. So practically a flat quarter. When we look at globally, we're actually seeing a little bit more differentiation. And certainly, when we consider international markets as a whole, we're seeing returns of closer to 4% for the period. And here, this is largely driven, unsurprisingly, by those US tech stocks. So your Facebooks, your Amazons, your Google, your Netflix, all those kind of beneficiaries that we're all very aware of have enjoyed the stay-at-home lifestyle that's been imposed on us. So when we look out across investment markets, that there has been differentiation between the different asset classes, different sectors, and different companies. And of course, that makes intuitive sense. We've already mentioned how the tech companies have benefited, but so have other sort of supported companies for the change in lifestyle and those protected from lockdown effects. On the flip side to that, your hospitality companies, your companies linked to tourism, all those ones that really need face-to-face interaction with their clients are the ones that are being impacted the most negatively. Equally, when we look out across countries, the UK had a pretty tough quarter, being down 3.5%. That very much ties in with their increasingly difficult negotiations around Brexit. It also ties in with their second wave of COVID infections, which is now at about the daily rate is now at about 3 times what it was at their peak in April. Germany, in contrast, has actually done much better, and Germany was up about 4.5% for the quarter. And there you're seeing a better experience of COVID infections and a generally more robust economy. So, what we're seeing is that, real blend of winners and losers from the current environment, even though, at the top line, everything is relatively benign and relatively in line. So from a monetary support point of view, the RBA has sort of definitely depleted what we would call their conventional toolkit. Which is effectively controlling the interest rate of cash. So, given that the current target rate is down at 0.25%, there's very little that they can do to further reduce it. Further to this, when we look at the views coming out of the Reserve Bank, they really don't believe in negative interest rate policy. So we've seen in Europe and we've seen in certain other jurisdictions, indeed, New Zealand recently announced that they were considering it, going into negative interest rates. The RBA are really concerned that there's not much benefit in doing that actually the costs outweigh the benefits. And so what they're looking to do instead is utilize other tools. And that they can be quite creative with this, and we've already seen them start to deploy those. So rather than just focusing their interest on the cash rate, that they've been looking at managing the interest rate curve all the way out to 3 years. And there's more they can do around that. So, they've definitely spoken about how they stand ready and willing to do whatever it takes. And that's something consistent across central banks. But one thing that they have also done is made it very clear that there is a requirement for fiscal stimulus to come in to support the recovery. And I think we've seen that reflected in the budget that we saw released earlier in the week. So when we spoke last quarter, we certainly saw the room for the Australian dollar to continue to run. And we have done over this quarter. It's gained a good couple of hundred basis points, so a good couple of percent against the US dollar. Given that it's close and probably slightly above its long-term average, we feel that this is a relatively good baseline. That the outlook is so muddled, so uncertain, because we really don't know the path for the virus, that it's hard to make better judgments than that, because it's really dependent on policy actions of governments who at this point don't even know what their policy responses are going to be. So our view would be take the current level as your baseline for any thought and go from there. So a really big thing that markets are going to have to digest in the next few weeks is that of the US presidential election. And, when we consider how big the US is in terms of its importance to capital markets, as the world's largest economy and as an integral part of the global financial infrastructure, it plays a very big weight overall. So it's a big thing to concern ourselves with. I think, when we consider the real risks around this or the real impact for markets, the vulnerability tends to stem from a disputed election. So for the first time in history that we can identify, we've got President Trump and his Vice President Mike Pence both publicly refusing to endorse a peaceful transfer of power should they lose the election. And this is something that would be really hard for markets to price the risk of. So from a risk point of view, this is a big thing, even though we ultimately think that's a low probability event. The really good thing for markets will be a strong win either way, because that will then open the door to stimulus and just dramatically cut the uncertainty. So from our point of view, the best result is one of a clear win either direction. So second waves of COVID are starting to impact economies and markets. When we look at the reasons for this, and I'm certainly all too familiar with this being based in Melbourne, we recognise that this is part and parcel with how we're likely to recover from this shock. When we go back to the IMF's discussion earlier in the year, what they were really talking about when they were talking about the Great Lockdown was what we have here is an economic crisis born out of a medical crisis. And so really, until we have a vaccine, we don't solve the medical crisis, and therefore we can't really solve the economic crisis. And so second waves are an important thing, and we expect them. That there's no surprises that these are occurring, and it's exactly why we're seeing authorities standing ready to adapt. And it's also why so much political emphasis is being put on the delivery of a vaccine. Our overall outlook for investment markets moving forward is really solving for the combination of an unprecedented amount of stimulus having to meet an unprecedented economic shock. And that's a tricky one to solve for. Initially the stimulus measures that have been put in place are rather blunt instruments. And over time, those are going to need to be more specific and really looking to deal with individual problems as they crop up. Now, fortunately, the both fiscal authorities, i.e. governments, and monetary authorities, central banks, have all pretty much universally said that they stand ready to do whatever it takes. Things to be aware of, or certainly the big three things that we consider, are the US presidential elections, the US-China trade relationship, and Brexit. When we think about positioning portfolios, we tend to think about optimizing over the long term, which from an investment theory point of view stands in a lot of reason. In long-term investment returns tend to be more stable and indeed more predictable. The real issue and the real time that you should be considering shorter term changes is when you have shorter term needs, and by that we generally mean withdrawing from the portfolio for short term cash requirements. So, ultimately, you should be positioned for the long term, but if you do have a short-term requirement, the coming months are likely to involve a decent amount of volatility. Now, that could benefit you or it could harm you. Certainly, if you have that short-term requirement, it's probably prudent to take whatever little bit of cash out of the portfolio now rather than wait for the vagaries of the market.